Hey, everybody, it's Hammer, your vetted VA rate guru, your mortgage market guy, letting you guys know what's going on with rates this week. Joined this week with JD. Do you pronounce it Mathau or Matau?
Matthew.
Matthew. See, third time's a charm. With JD Matthew, a vetted VA VVA4 member. And JD, please introduce yourself. Tell everybody, what is VVA4? What does that mean for them? What does it mean for you?
Sure, absolutely. Hammer VVA, when you join vetted VA, there's different rank structures. All your moderators, once they start, by the time they get to the group to moderate, they are VVA3. That means they've passed all the tests required. Getting to VVA4 is akin to getting promoted in the military. We're constantly evaluated. And once the leadership deems you ready to take on additional responsibility, you get promoted.
Very good. So that means that you have been vetted and you give really good veteran advice, VA mortgage advice, and that you've had to display and show proof that you know what you're talking about, right?
It should. I certainly hope so.
Awesome. So, well, everybody, let me go ahead and share the screen. Let's pop this up next to us here. So today is August 10th. This week, we're going to talk about what's going on with mortgage rates. Let's start off with the advice that I gave early in the week. So on Monday, I wrote this, and I gave a quick recap of what happened last week. Rates got slightly worse last week. A lot of the reason for that was the jobs data that came out on Friday. So what happens, average mortgage rates started off the week improving, and it looked like we might see rates improve on the week. But unfortunately, we ended up seeing rates get a little bit worse by the end of the week, which is why, great example of why it's so important when you're shopping around that you are always shopping at the same time window and that you are not comparing a rate quote that you get on a Friday to a rate quote you got on a Tuesday, because the markets behind the rates change and the rates themselves will then change, and you'll want to make sure that you're giving an apples to apples comparison. So anyway, what moved markets for the week was the unemployment data that we got on Friday. Now, JD, do you follow the jobs data stuff? Most people don't. So if you say not really, that's okay. That's actually a good answer. But do you know what the jobs data is that came out last Friday?
No, I don't follow it. I just follow your data. You follow the jobs data, and I read your digest.
Okay, and that's perfect. So and everybody that's watching is probably in that same boat. So real quick to give everybody some insight into why was this jobs data an issue. So the economy is basically pushed by how well the labor market is doing. If the labor market is strong, if unemployment is low, and wages are doing well, we have a strong economy. People are making money, people are spending money. And right now, mortgage rates, we've talked about how there's kind of a horse race between fear of recession and fear of inflation. And those are the two horses. This is a two-horse race at this point. And when fear of recession takes the lead, mortgage rates improve. And when fear of inflation takes the lead, well, mortgage rates get worse. And one of those drivers to a recession is a labor market that is losing ground. So higher unemployment, less jobs, more layoffs. That's going to, to basically roll into a recession. It's usually the kind of the tail end of a recession. As a recession starts, we usually see the labor market start to lose ground. And when a labor market is showing strength, that shows that the economy is still improving. So if the economy is strong, fear of inflation leads the race, which means that mortgage rates generally get a little worse. So for all of you vetted VA folks, for all of you consumers out there that are watching to see, hey, how do I know which way things are going? That's what we use to forecast where rates are headed. Is we're looking at what is the economy doing? What is the labor market doing? What is inflation doing? What is the Fed doing? And we're going to talk about that today. So I'll go back to those charts in a minute, but I did not remind y'all, do me a favor. If you're here today, tell us hello, give us a hashtag live. Let us know that you're here. If you're watching on the replay, give us hashtag replay. Let us know that you are watching. We do monitor this thread, these posts on Facebook. So if you do have any questions and you're watching this on Thursday or Friday, then ask those questions. We'll make sure we get those answered for you as well. But if you got any live questions, put them in the comments and JD and I will answer them for you. And basically what we're going to talk about today is what happened with rates and where we think they're going. And we'll give you guys some ideas of what to do depending on what your interest rate is. JD brought up a really great point before we started the live about
Mhm.
what do you do as a consumer if maybe rates are improving and you've already locked in a higher rate. So we're going to talk about that. So if you may be in that situation, that may be something worth staying towards the end of the live or fast forward on the replay and see what we talk about with that. So, right, JD?
Absolutely.
So, quick thing about last week. So, there were more new jobs created. It was really strong data that came in. It was actually almost double, actually, it was more than double of what was expected. So, there were a lot of new jobs created. Unemployment fell from 3.6% to 3.5%. All of this with a strong labor market means that the Fed is more likely to raise rates at their September Fed meeting. And because of that, mortgage rates were affected now. And we've talked about this in past sessions, JD, but I'll kind of go over it here so that all of our viewers can kind of get an idea. But when you have the Fed, we're watching what are called Fed futures, and let me
Mhm.
pull up a chart so everyone can kind of see that. What we're looking at is the Fed meets, I think it's like 8 or 9 times a year, and it's not necessarily every month, but it's almost every month. And the next meeting is going to be September, and it's going to be September 21st. So we're about 5 weeks away from that next meeting, and everybody is trying to figure out what is the Fed going to do. They want to, investors, traders, they want to act now before the Fed is. So the speculation actually affects mortgage rates today. So when the Fed raises that Fed funds rate, their policy rate, it's not going to hurt mortgage rates when they raise it. In fact, it'll probably help rates a little bit. But right now, weeks in advance, we see mortgage rates get worse like we did last week
Mhm.
because the expectation that we were going to see a 3/4 point rate hike, which is this column, I'm sorry, a 0.5 point rate hike, which is this column, versus a 3/4 point rate hike here. Right now, this morning, we got about 2/3 speculate we're going to see a 50 basis point rate hike, a 0.5 point rate hike, and then about a third think we're going to see a 3/4 point rate hike. But just after that jobs data, if I change this chart up for everybody, what you're seeing with these lighter blue columns is that a week ago, almost 60% believed we were going to see that larger hike, and only 30 or 40% believe we were going to see a smaller hike. So it was actually the opposite of what we were actually seeing right now is what happened. So that's why we saw that change up there. And that's why we saw rates go up a little bit, last week compared to where we thought they were going to be at the beginning of the week. This week, though, we've got some really good news. We figured we could see some volatility, and the volatility, everybody that's watching today, you guys are on at the right time because that volatility was actually because of inflation. And we got that report this morning. So, JD, did you see what happened with inflation this morning?
No, I actually did not.
Okay. We'll bring it up and then we'll chat about it. So inflation came in
Remember, you're 3
cooler.
hours in the future.
Oh, that's true. Yeah, you're in California. So yeah, you're still waking up. Yeah, I've already been running for the day. So inflation came in cooler than expected this morning. And what that does is again, kind of what we were talking about before, you've got the two horses in the race. You've got
Mhm.
the fear of recession and fear of inflation. And as
Mhm.
fear of inflation, when that one leads, rates get worse. So when we saw the strong jobs data on Friday, that kind of shifted market speculation, and they thought inflation may be more of a concern. If the economy is heating up, that is, drives inflation. And that was why we saw mortgage rates kind of creep up. Then today we got data that actually points to fear of recession. When we see this inflation data start to pull back, that gave fear of recession a chance to catch up. And that's why we've seen mortgage rates kind of improve a little bit today versus where we were at just yesterday or even the day before. And we've seen a lot of movement in mortgage rates recently where rates have actually, on a Wednesday, they may be, and again, these are just pure fictitious numbers, everybody. These
Mhm.
are not quoted rates, and I'm just using round numbers to make it easy, right? So on Wednesday, they might be 4.875, and on Thursday, they might be 4.625, and then on Friday, they go up to 5.125. So you see this big movement in rates, and it's basically depending on what's going on behind the scenes in the bond market with mortgage-backed securities, which we've talked about in the past about
Mhm.
how that affects our mortgage rates, and we see that movement. So JD, I've done a lot of the chatting. Now I want you to explain to everybody, and what would happen if you see somebody that did lock in an interest rate and it was a little bit different. If it's maybe they locked in 4.625 and today they could get 4.5. Is that something that they should really worry about?
At this point, I mean, that's a very small difference. And from what I've been seeing, the trend uh, says that hopefully by the end of the year, early next year, we might have lower rates. And so if you're at a point where you're in the middle of a transaction, I would personally urge you to keep going and close the loan. After 210 days after your first payment, you can do a VA Streamline refinance. Now, if the difference is drastic and it will save you hundreds of dollars per month, then consider doing that. However, uh, I'd say speak with your real estate professionals to make sure that you can get everything done within your contracted timeframes.
Okay, so and I'm just going to kind of reiterate some of what you said there, and then ask you a couple questions on it. So if I locked in my interest rate and I was getting 4.625, and today I could get 4.5, you're saying that even though obviously there is a difference, it's a small difference, and I wouldn't want to necessarily upset my apple cart and affect my closing. Now, if I lock in my interest rate, can't my loan officer just give me the next lower rate lower?
Well, there's a few ways it can happen. So, first way is certain lenders have a float down policy. Uh, However, it has to be a difference of at least 0.5% in the rate, usually for most lenders. If
Okay.
you're working with a broker and it's a huge difference, they can also potentially withdraw the loan and submit it to a different lender. However, you have to go back through underwriting.
Right.
Uh,
And that could affect the time frame and how long things take. So in other words, they can't just magically go in and say, "Okay, we're just going to give you that lower rate." It's not that easy, right? There's a whole
no,
process because there's a business behind locking in these loans. And
exactly.
for to give those of you that don't fall asleep, here's your 1 minute warning. I'm going to give you the TED talk on why that locking in isn't something that they can just change. What happens is when you see a mortgage, you as the consumer are getting the mortgage. What you don't see is all that's happening behind that process to bring that money to you. And that money is going to waterfall its way down through different channels before it lands in your lap. And that's going to happen all the way up to the bond market and Wall Street, which is what we monitor. And I like to share this with y'all every once in a while. We'll bring this up on the screen. So these are the bonds that we're actually watching to see, hey, which way are mortgage rates going, and what do we think they're going to do over the next few days. So this is what's happening on Wall Street. And when your loan officer helps you to lock that interest rate, what's happening is the lender is promising this loan, your loan, after it closes, that they're going to move that farther up the chain. And then
Hmm.
there's a certain amount of profit that they've locked in to work with on that. And then once it goes to that next level, they're actually looking at securitizing it. And this is all called TBA. And it's basically forward thing, to be announced, or it's all forward sales of loans. So when that loan is locked, it's not just the lender saying, okay, we're going to give you that rate, and that's our rate today. They're keeping that money, that flow of money coming in from up above from these different channels, or what we call the secondary market, and they are on the hook to those channels. It's kind of like if we all borrowed money and it came down its way, right? So the loan officer can't just wave a wand and say, okay, well, I'm going to give you the better rate. If it were that easy, they would all do it. But go ahead, JD. You look like you want to jump
So,
in on that.
so what I'm hearing is there's a commitment on multiple levels to give you that
Mhm.
rate at that point. So, I guess what I'm understanding is there's a give and take, right? The investors are committing to lending you the money at, let's say, 4.625%.
Right.
If the rates increase between when you locked and when you're closing, they're taking on that risk.
Yeah. And
But
you're
on the other
protected.
hand, and you're
Yep.
protected. But on the other hand, uh, there's again the give and take. If they go down, they've already committed to lending you at that money, at that
Right.
interest rate.
Right. So, and that's why when you lock in an interest rate, you're locking it in, it protects you. And that's why we do this show every week to help you as consumers just to have an idea of what's affecting rates, why we think they're going to move up or down, or what you should be aware of. And again, I don't have a crystal ball, but we do know based on the different the different factors, which direction rates are headed and why, and we can make an educated judgment. So, for example, I'm going to bring that screen back up here. When I did the advice on Monday, I said, hey, we could see some volatility in rates this week because mortgage rates could move significantly day to day. based on how markets react to consumer and wholesale inflation data, as well as consumer sentiment readings. And those will come out on Friday. The longer term outlook is still good for rates, but it's a good week to stay in touch with your mortgage professional if you have a loan closing soon. And the
Mhm.
reason that I was giving that advice is that today was one of the things we talked about was consumer inflation data. And that consumer inflation data came in better than expected. And what that does is, if I make this chart full screen here, we're seeing a peak to the inflation. Okay. We're seeing a peak to the inflation. And that's what we've been looking for. So the July inflation is a little bit lower than the June inflation. Now, it's still not good. 8.5% inflation is definitely not a good thing, but they were estimating it would come in at 8.7. They estimated that inflation without energy and food costs, they call that the core inflation. They
Mhm.
figured that would come in at 6.1%, and it actually came in at 5.9%. So when we got a little bit better inflation than expected, that means that today you're going to see mortgage rates improve a little bit. Now, does improve mean going from that 4.875 down to 4.5? No, you're not going to see a dramatic jump in rates, but maybe 4.875 yesterday's quote, today might be 4.75. And again,
Mhm.
these are totally fictitious numbers just for illustrative purposes. These are not, you want to get a great quote from your lender. You want to shop around, like Christopher Griffith and I have talked about many times in the past, but you want to shop around the right way. Make sure you're comparing apples to apples. Where are you at today with today's market after the CPI data? And that's where you would want to make your decisions on that. So if there is a big move, though, let's say that, if rates did drop 0.5%, JD, you mentioned that there's usually something that the lender can do called a float down.
Yes, and not all lenders do that. So with the float down, they allow you to lower your rate. There is what's called a little bit of a pricing hit. I've actually never had the occasion to do one yet, but it is an option that's out there for certain lenders. Or you could potentially withdraw the loan and start the process all over again.
Okay, so if there was a very big movement, definitely talk to your mortgage professional, find out what options they have available, see if they have one of those float down options. They may or may not have that. If it's
Exactly.
a mortgage broker, they may be able to move your loan to a different lender, which again could have a lot of implications. Now,
Hmm.
if rates are a little bit higher and they've gotten a little bit better, we all have fear of missing out. Everybody wants to get the lowest rate that we can. But let's say that any rate that we get today, maybe it's in the high fours or the low fives. Where do we think, JD, we've talked about, where do you think rates are going to be a few months from now? Or again, we've talked about 210 payments. That's 7 months from your payment due date. So not the day you make your payment, but the payment due date. So where do we think rates might be in 7 or 8 months from now for people that are locking and closing today?
I think we'll be in the low fours, maybe very high threes. Uh, and I actually hope it is the case because a lot of people could actually potentially save down the road. But
Yeah.
again, we don't have a crystal ball.
No crystal ball.
We thought we thought earlier this year that we basically stayed a course,
Yeah.
and when the Fed announced that rate hike that one time, the market went crazy, and we went from rates in the twos to rates in the fives.
Yeah.
And
Yeah.
so,
So, and we saw that go up. So for everybody that's watching consumer wise, JD thinks rates are going to go down, could be high threes, maybe lower fours. Why do we think the rates are going to get better and not worse, JD?
well, right
Think
now
of
there's
think of the
more.
horses, talking horses, fear of recession, fear of inflation.
So right now, I believe the Fed is actually trying to control inflation. And so by controlling inflation, that may cause a slight recession. Uh, on the other hand, the investment market, the bond market, they try to make sure they understand where the Fed is headed. I know there's not a direct relation between the Fed funds rate and how they price their bonds. However, they actually want to look at certainty in the markets. And so
Yeah.
the more certainty they have of what they understand what's going on, the better they can actually price their products.
So, JD, this is the chart that you're actually kind of when you talk about the bond market. So, for all the consumers watching, when we talk about where your mortgage rates come from, there's basically two factors that affect your mortgage rates. The first one is where almost all of the money is replenished from. How can we have money to lend over and over and over? And it's because of the securitization of loans and Wall Street. We're getting that money as we securitize these loans as bonds. It replenishes the money to the lenders and the banks so they can continue to lend it to you as a consumer. And then the second piece is, of course, the margin. What is the lender profit? And that depends on, how the lender runs their business and how much overhead they have and expenses and how much profit that they've got worked in. So those are generally your two variables. Now, that's why we encourage you to go ahead and shop around so that you find somebody you're comfortable working with
Hmm.
and also somebody with good margins that can give you rates on the lower end of that spectrum, or at least that you're not overpaying like some of the companies out there will take advantage and have very large margins, especially the ones that advertise a lot. Let's just put it that way. The other thing is this is the bond market. So this is where the basis of rates and what I want you guys to see is there's all these red and green little candlesticks. I'm actually going to move this to what we call a line chart so we can just see a line movement. And as this line is higher, that means mortgage rates were actually lower. This is inverted. So as this goes down, mortgage rates went up. And we saw that there's a little down at the bottom here, you can see the dates. So September of 21, October of 21, November of 21, we had very stable rates, a lot of times in the threes. And then, like JD mentioned, rates moved up higher into the fours, into the fives. And at this really low point here, a lot of maybe not so much on the VA loans, but a lot of conventional loans, even in the sixes. And this was
Hmm.
in June when we had a very an inflation reading that created a lot of panic. So you could see that we've seen rates that have kind of this was the highest level of rates is the lowest point on this chart, and you can see that we're getting a bit of a recovery, but it's a choppy line. It's not a straight line. It goes up, it comes down, it goes up, it comes down. So what we're expecting is as this recession grows, or as the fear of recession grows, or as a recession takes place, when the Fed is raising policy rates, what they're doing is slowing down the economy. And
Hmm.
when they slow down the economy, that's going to bring on, a recession. And then we're going to continue to see this chart move up. And that means rates are going to continue to get better. So that's what we're expecting the later half of the year or into 2023 as the Fed makes all of these moves here that we track. They've got a September meeting, we've got a November meeting, we've got a December meeting, and this is forecasting where the Fed's policy rate will be. And the higher they raise that policy rate, the more they slow the economy down. But remember, we don't see mortgage rates move when the Fed takes action. The Fed will definitely raise rates September 21st, whether they raise it the expected half a point or what some people expect at 3/4 of a point. We're seeing mortgage rates react now. They react early. So on the speculation of what's going to happen. So that's why we kind of monitor all that. So we'll wrap things up, JD. We'll just give everybody kind of an overview, as far as what we think is going to happen with rates in the near term. Rates should be pretty stable. We shouldn't see any big jumps, but you're probably not going to see any large improvements either.
Hmm.
If you do have the opportunity to lock in an interest rate, if you don't want to gamble and you like where you're at and your payment is comfortable and affordable, this is not a bad time to lock in an interest rate. If
Yeah.
talk to your individual loan originator, your professional, and get their opinion. But it's not a bad time because we are on that lower end of the spectrum that we've seen over the last couple of months. We did see rates peak in June. They have come down significantly since then. It's a good time to take advantage of that rate. But if you have something, maybe new construction, and you're not closing for months and months from now, don't panic. It's very unlikely that we see rates go up significantly higher from here. And in fact, we may see rates get slightly better from here. So if you've got something closing on the near term, it's a good time to consider locking, or at least, check this stuff out, and take a look at where where you're comfortable with your payment. If you've got something with some time, we could still see a little bit of improvement over the next couple of weeks, as we head to that Fed meeting coming up in September. And what's going to drive things, if you're watching your headlines and you see the fear of recession, a lot of recession headlines, generally mortgage rates are going to react positively when we see a lot of those headlines. If we see a lot of headlines and inflation is a concern, the economy is doing well, stocks are doing well, generally mortgage rates are not going to react as well to that. They may kind of stagnate or get slightly worse. So anything, JD, that you'd like to add?
Yes. So like you said, if you like it, lock it. Uh, if you are in a new construction, my opinion might be a little bit different for certain cases. So if you are close to your limit and you can lock the
Mhm.
rate that you want right now, I would go ahead and do that and hedge against the risk that something unforeseen happens and the rates increase.
Yeah. So and again, that's why all of that factors in. And if you guys have any questions, if you want unbiased opinions, that's what the vetted VA group is for. You'll find that all of your professionals like JD are going to give you the best answer that they can. They're going to point to how they came to that answer. And they're not biased. They don't have a dog in the fight. They're here to help you, serve you, and take care of you. So if you have questions, feel free to post them here. We will do our best to answer them for you. We don't have a crystal ball, but we do have some stuff to hopefully educate you so that you feel comfortable, that you're able to make the best decision for you and your situation. So, JD, well, thank you for joining us. Appreciate having you here, my friend.
It was a
Hopefully, we'll see
pleasure,
you again
Hammer.
in the future. And
Hopefully.
everybody, remember, if you did enjoy today's show, do us a favor. Do give us a hashtag replay. If you were here live and you have any questions, post them in there and we'll answer them before we leave. But it looks like we just looks like no real big questions today, so I think we're pretty good, and we'll see you next week. Remember that we do this. Let me bring my little slide back up. We do this each week to discuss what's going on with you with mortgage rates. It's 12 p.m. Eastern, 11 Central, 10 a.m. Mountain, and 9 a.m. over in JD's neck of the woods. That's right. He's up and at 'em early this morning at 9 a.m. joining us. So thank you again, JD. Appreciate having you here, my friend.
Pleasure, Hammer.
Take care, everybody. Bye-bye.